Hey, Paul Christopher is head of global market strategy at Wells Fargo. Paul, you want to jump into the debate we were just having? Welcome.
Well, I don't cover individual companies, but yeah, it does make sense to us that the hyperscaler concerns about sustainability are just not realistic yet. You're going to still see $650 billion in spending this year alone. Those companies have to compete with each other. That does mean putting the metal in the ground.
Yeah, I wonder if it means market caps will inflect once again. Exxon is about $600 billion today, and Meta's $1.6 trillion. And you wonder if you spin the story forward 5 or 10 years, does that flip-flop? I don't know. But how strongly do you feel about the materials and energy and supply chain companies right now?
Well, we do like industrials right now. We also like utilities. We also like financials. So what we're trying to do here is two things. First of all, play an economic recovery or stronger growth theme, let's call it, that we think is well entrenched for this year and has not been paid enough attention to so far this year. That's the first thing. And the second thing is that, you put your finger on it a moment ago. No one really knows what the adoption rates, the monetization rates are going to be like going forward. So there's no point in taking excessive investment risk in these companies, but you do want to play the trend because AI is here to stay. And so if you're taking industrials, you're taking utilities, you're buying into the whole let's call it an adjunct theme of data centers, which is still a theme that needs to be developed. And those PEs, those valuations on those companies, they're not that strong. So they're not overpriced, in other words. So we think there's good opportunities there, industrials and utilities. And if you think financials, too, that's a good way to play. If you want to hedge against the AI theme, hedge by taking on a stronger economy. For this year, we're seeing regional banks do really well here. We think the tax refunds, the deregulation, and that spending by the hyperscale is going to be important going forward. Financials should benefit.
If I were a financials investor, I'd go, wait a minute, that's what I was doing. What happened? They just had their worst day since April yesterday. Really big declines across the board. Is that just some kind of reset for what's been a strong trade or a sign of more trouble to come?
No, we don't think it is a sign of more trouble to come. Whether it's a reset or a kind of a repositioning, again, the regional banks doing really well here. If there's wonders about or questions still about that 10% cap on interest rates proposed by the administration, that's probably lingering in the background there still. But we still like the sector very much. And if I had $1 to put in the market right now, put it in financials.
What do you make of this preference for consumer staples over consumer discretionary? Should we read this as a preference for something that can't be Gen AI'd, to use the Peter Bookvar term? Or should we read this as a market rotating into a more cautious and defensive position?
Yeah, I mean, look, we've seen the market. The big rotation here is the one from services to goods. And so goods are going to do better here. And that's the real fear about the economy. And so if staples are going to do a little bit better than discretionary, yeah, that might be a kind of a continuation of that theme that we better stay with staples because AI is going to destroy a lot of jobs and put the economy in recession. We don't believe any of that. We're unfavorable on staples, but we would definitely be thinking that, this is what markets are thinking. Just look also at sort of the options. If you look at the S&P, the options and the VIX have really skewed towards a big pullback, a big correction that was probably related to fears about the economy. We think all of that is overdone.